All right, guys. Another seesaw day in the market. Every time I open my phone, it was a different story in the market. So, first off, do me a favor. We have 3 Instagram accounts: Everything Money Investing, Paul Gabriel, and the real Mustafa Hussein. Follow them all below. We do a lot of posts, a lot of reactions to things. We don't talk a lot about the market, but we post things we find interesting. We're very active. So, the market today. Let's go check out SPY. The market finished today down 0.78. But let me actually go to the actual market for the day. Look at this. This is crazy. Look at the percentage-wise. It was down 0.6, profit down 0.5%, up 0.4%, finished down almost 1%. Okay.
Here's the 15-minute chart. So this, every single one of these candles is a 15-minute, 15 minute. Look at this thing just moving all
Mo, right?
day.
Stop.
Boom.
No, go to the top.
Right up here.
Look at that. No, 3 more to the right.
Here?
Yeah. That's engulfing.
Yep. Oh,
and
yeah.
down. So if you were day trading this,
good volume, you're dropping under, right? Perfect. It's lining up perfect.
That's I mean, look, that's incredible. So let's look at the NASDAQ.
And look at the last 15 minutes of the day. Just boom.
Pull up the NASDAQ, would you?
Yeah. 15-minute chart.
Yeah. It just goes to show how, I mean, it's the same thing.
Same thing. Massive surge in the last 30 minutes of the day to the downside.
Man, you could have made money just that last 30 minutes using those charts.
Exactly.
So guys, look at us. We're a channel about investing and putting your money to work. Some of it's value investing, some of it's charts. There are multiple ways to skin a cat. There are multiple ways to make money. Follow our channel, subscribe to us. We have over 1,900 videos. We have a community where we talk about options, day trading, value investing. There are multiple ways to make money. I do a lot with value investing and options. I dabble in trading. My trading is long-term swing trading because I like seeing paths. I like seeing the long-term trends for companies. I'm very fixated on support levels. I'll text Mo all the time. Mo, where's the next support level for blah, 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 blah. And he'll look it up and say, hey, right here, or where's the resistance? Oh, right here. Because I'm not using that as a way to make a decision on my value investing, but I use it as a way of saying, should I wait a little bit longer to see more support and see if I could probably get a stock at a lower price just based on where the momentum's going. Yeah. It's all part of using them all together. But today's market, guys, was crazy. This is the last month in the S&P. Up a lot. Okay. But on a day perspective, to me, this is an indication of the market doesn't know where it wants to go. And when there's uncertainty, is that usually a good thing or a bad thing for the markets?
Bad thing. Now,
I'm going to reiterate. The market right now, let's update my S&P 3957.5. The market is currently 66% overvalued. Fair value is still 2384 based on GDP that was reported. Now, in history, the average 10-year return, not including dividends, is 6.6%. When you're undervalued, it's 9.3. When you're overvalued, it's 2.3. The scary part is when you're 30% overvalued or more, and we're at 66, so it's over double, you average a loss over the next 10 years, not including dividends. So where do we stand right now? I just don't think the next 10 years are going to be good, but it doesn't mean you can't make money. It just means if the market goes like this, if you dollar cost average, you'll pay an average of this and therefore make profit. That's how you make your money. That's exactly how you make your money. Your job is to stay focused on the long term. You're telling me that today, the market went up and down 0.5% each, so 1% swing. So you're telling me the market was worth 1% more at one time of the day versus, come on. Doesn't even make sense. It's the emotions of the market. And the emotions of the market can get worse. Look at FTX. It went under last week. My argument is FTX was never worth anything. I don't think crypto is worth anything. I think crypto is literally worth zero. And the market finally said that with FTX. Oh my God, they were doing this. Okay, great. Whatever they were doing, fine. But the bottom line is the market will eventually, over time, dictate the value based on fundamentals. But in the short run, the Mr. Market will tell you a price based on what people's emotions are. And you have to decide if you're a buyer or seller at that given moment. And right now with the market up last week, inflation beat by 0.2%. The market skyrocketed. NASDAQ was up 7.5%. S&P was up 6%. This is the best day ever. Inflation's done. I'm like, inflation was still 7.7%.
Still a lot. Actually, you had one of the Fed governor came out and he's like, guys, this was an overreaction.
Yes.
We still have 7.7% inflation.
He said, and I don't think it's going to get that much better. He's like, it's one data point of many.
Yeah.
I think he was kind of saying like, guys, pump the brakes. Yes, it's better news, but it's not.
And he also did say, we've had multiple times in the past year where it's looked a little bit better and then it gets worse.
Man, it's just, I look at this saying, guys, don't get fixated so much on the news. I don't watch the news. You know, I just had lunch with a good friend of mine. He's a wealth manager. He's like, hey, Paul, did you see this show on CNBC? And I finally said, Michael, you know me, I don't watch CNBC. He's like, oh, that's right. I don't care what other people are saying. I don't want to get myself entrenched in this news. Why? My goal is to look at the long term. And the more I get affected by the day-to-day news stories, the more I'll start making decisions on the day-to-day. Now, does that mean I don't look at the market every day? Of course I do, because I still like seeing stocks go down. And when they go up, I go, okay, where am I seeing mispricings here? Maybe I can sell some options on those mispricings and make some money. And I've done that very successfully. But overall, it's easy for me because I see how overpriced the market is. I believe we're in still the start of a very long-term bear market. I don't believe we're hitting a low anytime soon. I do believe that we're going to have to test COVID lows.
Yeah, that'll happen.
Mo, why don't you show the support levels for S&P?
So this is S&P, and actually something interesting that I looked at this morning on the morning show. So right now, I'm going to just draw a couple of these lines of just coming down. And you can see these are the new resistance points. It's going to be very hard to break through those points. And right now, I'm seeing kind of this level right here. That level is 405 on S&P, that on SPY. That's where I think that next resistance point is going to be. We're going to hit that, and then we're going to have this trickle down effect. And what did it close at today? 395. So outside of, I mean, it's going to have to drop. If it drops below that 355 number, that's when I think we're going to be testing these COVID lows, because there's not a lot of support in here, with the exception of that little bit of consolidation. They gave away so much money, and the market's just skyrocketed.
So this is how you use. That's the thing. I don't sit there and say I'm going to make my investing decisions based on that. But once the market hits my point that I want to enter, I'm going to sit there and keep track of it, saying, hey, for example, if I thought the price of 355 was my market entry, I might wait and go, okay, Mo, you think 355 is if it goes through that, it might just really drop. So I'm probably going to add less aggressively or sell puts at much lower prices.
Yeah.
And that's the point.
355, it's going to be pretty aggressive to the downside, just because there's none of those W formations going up that create these support levels on the way down. So
I look at this and I go 1 year on SPY. The lowest it's gotten was 348.
Yeah.
But it was very temporary.
Very temporary. It was
intraday.
Yep.
Actually, so it never even closed.
Actually, if you look at it.
Did you look at it?
If you look at it, look at that. It did close right there.
What was that price there?
That day closed. The low was 348.11, and it closed at closed at 365.
That's what I mean.
Right.
Yeah, it didn't close.
You're right. 348.
It was that day where it was the biggest rebound or something like that. It was like an insane day.
You're right.
It was an insane rebound.
I was just looking at that little tiny wick, and I was like, oh, that's not much.
But you know what's amazing? If that had closed below 355, that might have been an indication from Mo. That could have been it. But it rebounded, and it was a great day for everybody. Praise the Lord. Everything's fine.
Exactly.
But guys, I repeat over and over the long run, fundamentals matter. And I look at this data that I have going back to 1929, and the stock market to GDP ratio is just way too high. What it's probably going to be is inflation will be your friend here. I repeat, inflation will be your friend here. Not many people are talking about how inflation is your friend, but it'll drive up GDP like it has in the last few years. The faster and faster GDP grows, the less overvalued the stock market is at current levels. But it'll probably end up being a combination of GDP going up and prices going down. That's what happened from 1966 to 1982. Let me show you that right here. In 1966, that ratio, stock market to GDP, hit about let's see where the high was, 1.23 in 1964. And up to 1982, look how low it got, 0.329. But GDP went from 690 billion to 3.3 trillion in that short period of time. Why? Inflation. And with high inflation, it really drives up nominal GDP. And in the stock market GDP ratio, you look at total nominal GDP. That means GDP not factoring in inflation. So you're looking at nominal GDP, not real GDP. That's how you get saved out of this mess from the stock market GDP ratio. And if you look, The stock market's been overvalued based on relative to history since 2013, but the fundamental price has still gone up and up. Why? Because nominal GDP still keeps on going. And that's the big driver. So it's a combination of both. So I encourage you, still dollar cost average into low cost ETFs. But if you take a portion of your money to buy individual stocks, be ready, because I do think there'll be much lower times. I don't listen to any. The only reason I go to Market Watch is to get literally a laugh. I go to our software. I check the stories here on our software just to get a laugh over what people are saying about the markets. Oh, look, Michael Burry. That's not a laugh. But I look at this saying, look at this. Fed's Brainerd hints at slower rate hikes soon. I hear people saying, oh, they're going to reverse rates. Like, no. Now, is there a chance they reverse rates if we have some major recession that's awful? Sure. But I don't think we're in the permanent. I think from here, right now, historical average for the 10-year treasury is 4.4%. And I think we're currently at 3.9. And we hit a high of like 4.2 recently. So we're about the historical average of 10-year treasury. You got to remember these things. One of the other benefits to having high rates, guys, if you want a 90-day treasury rate, they're going to pay you about 1% per quarter, 4% per year for the government to hold your money for 90 days at a time. That's a pretty incredible rate. At the low, I was being paid 0.06%. That means for every $1 million you have in there, every year, they're paying you $600. That's insanely low. Now, for every $1 million, they're paying you $40,000. That's pretty incredible. So, again, I strongly encourage you, follow this channel, subscribe. Trust me when I say, if you watch 4 or 5 videos, you will have a better understanding of money because of our channel, because the more you learn, the less you fear, and that's the goal here, to manage your emotions. Take care, guys.